or you don't want a Matt Hancock moment, then feel free to turn off your camera, please. And also, please put any questions into the conversation or speech bubble icon on Teams, which you should see on the top, and we can look at those and address them at the end. So, as an introduction, I'm Steve Plaskett, and on the next slide, what I'm going to talk through today is whether it's a good time to effectively to invest or buy or sell businesses. And certainly, you know, the volume of mergers and acquisitions has grown throughout the pandemic. So the pandemic hasn't really impacted activity. Generally, there was a rush in the first quarter of the year. That was mainly due to fears about tax increases for shareholders selling their businesses. And then these tax fears didn't actually materialise, so the rules didn't change in the budget. But perhaps more on that later with Adrienne. But it's also due to greater private equity funding. We've seen this as a firm of accountants and a corporate finance team. It's been our busiest 12 months in the period to the end of May. And that's been despite a very difficult year for us all. And maybe it's because tax isn't the only reason that's driving activity. You know, finding the right investor for your growth plans is more important. Then to be a partner for them for many years before you choose to exit. So finding the right ones is key. So what else is driving activity? Well, private equity investment in many sectors is increasing. We've seen it particularly in business critical software, in online retail, and also, you know, green technology as well. So from the electric car market to construction companies, there is this drive to a green new normality, and I've met companies now who describe themselves by their commitments to sustainability and biodiversity and net zero, as much as by their turnover and profit. So we are looking at some significant changes going forward. These green companies, most of them are rich in intellectual property, and whether they're rich in, you know, something that is in intellectual property which can be protected, or whether it is in some new software, then there's clearly increases in private equity deals and the attractiveness of them at the moment. Looking at software as a services companies, in particular on this next slide, M&A has done particularly well, as you can see on here, that midpoint from April 20 up until March 21, you can see quite a steep increase since the pandemic has started. And that's probably been reflected by the valuations as well. So in general, across the whole of UK mergers and acquisitions, average valuation multiples have been broadly static over the last few years, between 7 and 8 times generally. Remember these are on eventual exit. For the UK technology sector, the median valuation multiples are a lot higher, and they've increased from 10.4 to 11.4 in 2020, which is evidence of the growing attractiveness of tech businesses. Now, having said that, we've seen tech deals successfully valued at over 20 times multiple last year. And we've also seen other deals that have fallen over 12 times multiple. So whilst there's trade buyers out there that are prepared to pay a lot, you need to get the investment ready. You need to get your investment properly delivering a pace that can attract those multiples, and that's what, you know, private equity is there for. So why is there such a difference between the valuations, and what critical success factors would we typically see? On the next slide, I'm going to make the point again about having a good business plan and also providing evidence. So it's the pace of growth that is available to businesses now, and it's that scalability that's going to be really attractive to private equity. In simple terms, it's down to planning and evidence. You know, for example, how far are you from achieving that tipping point of runaway growth, or are those new contracts secured? If you do have a goal and a direction of travel, then in a credible business plan, you will attract the private equity you want, especially if you have something truly unique as a competitive advantage. The biggest success factor, though, is confidence, and it's confidence in achieving the credibility of those forecasts. They need to be able to withstand up to scrutiny and due diligence, and in particular Mike Elliot in this case. But they need to be supported by management's plans and commitments as well as recent performance, existing data. When you're looking at data, particularly in the tech sector, there's probably some other KPIs that you need to be looking at. You know, it's the annual recurring revenue and that the growth within that is going to be critical. The last 12 months revenue growth, the retention rates, how you're keeping your customers, or how you're losing them, and that churn rate with them as well. And also the lifetime value of the client or the customer against its cost of acquisition. If you can get that right, then and look after your customers, then you're going to have a scalable business plan. What we haven't really mentioned on here is particularly for software companies is the viral rate. So this represents the rate of growth in customer numbers. It's broadly equivalent to the R rate that we've been familiar with in the pandemic. But the more that things can spread by word of mouth, then that's going to help you enormously. So what else? There's probably risks such as the level of hidden debt, of technical debt or future investment that you need, which is going to be really important for the investors to understand, so that as well as putting money into the company for working capital, they can see what level of money is required to get you to the next stage of the business as well. And finally, the deals that are being done at exit are often at higher multiples than those when private equity bring in their investments. So it's making sure that you've got a private equity investor who can help you to increase that value is key. But it's key to understand what other skills and experience and networking introductions can be gained from your new investors, and to make sure that your philosophies are similar as well. So with that, I'm going to hand over to Jeremy Middleton, who is the founder and CEO of Middleton Enterprises, and who is joining us from somewhere even warmer than Newcastle.
That's hard to believe, isn't it? Anyway, I won't upset people by telling you where I am, but it's nice and sunny. And I follow the rules at all times. I'd like to make that point. So I'm just going to give a bit of my background before we get into the heart of this webinar. So some of you may know this. My partner and I, we met back in the mid-80s over a bottle of mild green fairy liquid, because we were both working in marketing for Procter & Gamble in Newcastle. But we soon discovered we had rather more in common than a love of washing up liquid. We figured that we both wanted to work for ourselves, and we also realised that each of us had bought a buy-to-let property. And so we decided that we would go into business together, and we started buying properties on 100% mortgages, which is what you could do in the 80s, and what you needed to do if you hadn't got any money. And because we were able to buy a few, we set up a property letting business, which was called Professional Properties on Osborne Road in Jesmond. And over the following couple of years, we set up a whole series of related businesses, small businesses, from scratch: cleaning, ironing, property repairs, emergency services, plumbing, emergency plumbing. And the one thing I can say that all those businesses had in common was that they all lost money. So we spent all our money. We maxed out on our credit cards. We maxed out on our relatives' willingness to lend to us. And we spent all our tenants' deposits, which would be illegal today, but I can assure you wasn't then. It would have been if we hadn't paid it back, of course. And we nearly went bust more than once, but we persevered. I guess our first big break with hindsight was that the newly privatized water companies were all thinking about going into plumbing. And we persuaded one of them that the model they had, which was a regional direct labour standard plumbing business was a terrible idea. And we had a much better idea, which was to do a national franchised operation focused exclusively on emergencies. But better still, we persuaded them that the best way for them to do it was to form a joint venture with our plumbing business. And so we formed Fast Fix Plumbing and Heating as a joint venture with South Staffs Water. And over the following years, we turned our small, loss-making regional plumbing business into a big national loss-making plumbing business. Which takes us to our second break, which was to stop selling plumbing services and to sell warranties against plumbing leaks instead. So we stopped marketing to the 16% of people who had a plumbing emergency, and we started marketing to the 84% of people who didn't. And that turned out to be a much better model. And that business grew until eventually we were bigger than the water company. The water company was sold off. The company was renamed HomeServe, and earlier this year, HomeServe entered the FTSE 100 with a market cap of something over 4 billion. So that's where I started. Since then, in fact, since 2000, I've diversified away from HomeServe and focused on developing Middleton Enterprises as my family office. And our aim is to create and spread prosperity. So we don't own property, and we don't hold cash, and we don't buy bonds, and we don't speculate on currencies or commodities. We only do one thing: we invest in growing businesses. And I consider that to be a social good. So today, Middleton has around 100 million assets under management, and we employ 9 people here and in London. And our aim is to, over time, turn that into 1 billion assets under management. Because everyone should have a big, hairy objective, right? So that we'd become one of the largest investment companies based in the Northeast. And along the way, we hope to create a lot of prosperity and a lot of jobs. So we have 3 areas of interest. One is that we run a highly focused listed equities fund. And that team has a great track record, having compounded at a higher rate than Mr. Buffett over the last 7 years. Secondly, we invest in early stage B2B software businesses. So we have a joint venture called the Conviction Group. And Conviction is a global network of high net worths who invest in businesses that we believe could be the unicorns of tomorrow. But our focus today is on our growth capital. And we are looking for ambitious entrepreneurs who have a proven business and want to grow. A bit like HomeServe about 1992. We aim to be a bit different from other VCs, so you can be the judge of that. But first, we are investing our own money, not other people's. So we aren't a fund that needs its money back. Not that we want to lose it, you understand. But we don't have investors screaming if we miss short-term targets. And I think that makes us a long-term, reliable partner. Secondly, our experience comes from running businesses. So I have definitely made every mistake that is conceivably possible to make. No doubt I will continue to make some, but I believe that can be helpful. And third, we aim to be entrepreneur friendly. We know what it's like to run a business. And we only make money, and we only want to make money if the entrepreneurs we back make money. So that's the background to this. Mike Elliot is my investment director, heading up the growth capital division. He's been with me for nearly 10 years. Sometimes it feels more than 10 years. And he can tell you what we are looking for much better than I can. Mike, over to you.
Thanks, Jeremy, and thanks also to Tait Walker for inviting us here today. So as Jeremy suggested, growth capital, it sits in between that traditional VC funding and the listed stock market. And for us, it serves 2 primary purposes, which is to provide working capital to allow businesses to invest for their next leg of growth, and also to potentially de-risk business owners. So can I have the next slide, please? So what is it that we're looking for? Well, we're looking for great ideas. And we believe that great businesses solve problems. So, for example, we recently invested in Alertical, and that provides a way to ensure that older, higher needs people let others know that they're okay each day without having to make a phone call or having to have someone come to the door. And we also want great business models. So that means sustainable margins and a competitive advantage. So D-Line, another of our businesses, has patent protected design in its decorative trunking, so it can charge a premium price for a product that looks nicer than the competition and is also much easier to install, and that makes a compelling offering. It generally takes up to 10 years to build a business to critical mass, and we're looking for businesses that have reached that pivot point where they have achieved cash break-even or better, and now they need fresh impetus to drive the next stage of growth to reach meaningful scale. Could I have the next slide, please? So why do you want to work with us? Selling equity is really expensive. We know that you want minimal dilution, and we only want to deploy cash that adds value. So we don't want to stuff your company with excess capital so that we get the largest slice of the pie. And we're also enormously flexible, as Jeremy outlined, because we're private capital. We don't want preference shares or any other advantageous terms. We want the same share class as you have, so we make money when you do, and not unless you do. What we see is that most investors demand that owner-managers keep all their wealth locked up in the business until the investors get to exit. Now, we understand that founders have already taken enormous risk to reach the point they've got to. So we recently did a deal where the founder cashed out £1 million personally as part of our investment into his company. We believe that founders that are free of the fear of losing what they've built can be more effective operators. Now, Warren Buffett believes that the optimum investment period is forever. We agree. And in practice, what that means is that we're in for as long as you are. You keep control of the business and the exit agenda, and we help and support however we can. And we are determined to offer as much help and support to our businesses as we can. So, for example, I've led on debt raises worth £50 million for our investee businesses, HPB and Apex, because it's in everyone's interest for the company to have the cheapest source of capital. Equally, Jeremy and I have sat on interview panels for senior appointments, and we look to bring in resource expertise from wherever we have it within our company to help you when you need your help. Could I have the next slide, please? So if I just take you through a couple of case studies. D-Line. D-Line was set up in 2004 as an innovative cable management company led by its chief executive, Paul Ruddick. Jeremy actually invested in early stage VC rounds when D-Line was a startup. But when I arrived in 2012, he asked me to have a look at the business, and it was about 2.5 million turnover and about 400,000 EBITDA. By this time, Jeremy had already introduced D-Line to Nick Moore, and Nick has now been the chair of the business for over a decade, and he's been instrumental in the breakthrough to profitability, but also their continued growth. So on the back of the work that we did back in 2012 and 13, Middleton Enterprises led buyouts of other shareholders in 2013 and again in 2014. So we paid a fair price. We helped to rationalize the shareholder base, which helped the business make faster decisions. And also we built our stake from 15% to 29%. And then we supported them on a long and difficult but successful journey to break into the US market. And they've continued to increase export and online sales. We've encouraged them to build out a management team, move to larger premises, and widen their product offering. The business has been profitable every year since 2011, and it's been paying dividends since 2015. And gross revenue for their most recent year end is close to £17 million. There's still a great opportunity to grow that further via traditional and online retail channels. We are happy shareholders 15 years on from our first investment. Could I have the next slide, please? And then another case study, Alertical, I referenced earlier, was also founded in 2004 by James Batchelor. And there you can see on the screen the piece of tech which allows these older, higher needs people to just press a button every day, prompted by the technology, to check in and let their loved ones, or indeed whoever is running the properties, know that they are okay each day. James bootstrapped the company from its inception until now. So he's taken huge personal financial risk. The business is now profitable and it's in a healthy place financially. There's a huge opportunity ahead because this product is digital and the competition is mostly analog hardware. And there's a digital switchover coming over the next few years in the telecoms industry. James is keen to max out that opportunity, but he doesn't want to expose himself and his family to the sort of risks, sort of the knife edge that they've been on at various times in the past. And that's where we've come in. So our investment has been a mix of de-risking James and putting fresh capital into the business to fund the growth initiatives. So the business is already spending that money and ramping up sales efforts, which James probably wouldn't have felt comfortable to do without us as a partner. They've only got 2% of a growing market, and they've got a superior product to the big incumbent players. They've got really big plans to see top and bottom lines increase up to 5 times over the coming years. Hopefully this has been food for thought for you, many of you listening. Actually, can I have the next slide, please? So if anyone would like to discuss what we're doing further, then we'd be delighted. Please contact Jeremy, myself, or Emma. And I know we've got some time for some questions in a minute. And obviously, there are some interesting tax opportunities and implications for founders in undertaking these sorts of transactions. So I'll hand back to Adrienne and the Tait Walker team to talk us through that. Thanks very much.
Thank you, Mike. My name is Adrienne Peterson and I lead the transaction team here at Tait Walker. And I'm going to take you through some of the tax issues that a business would be considering when looking for investment. Next slide, please. So the one thing that we can say about the tax environment is it's forever changing. The rates change, the rules change, the reliefs change. And so I thought it would be useful to just give you some context as to where we are today with tax, because there's been a lot of discussion and speculation in the last year to 18 months, given the amount of government borrowing, and that will need to be paid back via taxes at some point. So what do we know? Well, the government has committed not to increase income tax within this Parliament. We do know, as was announced in the last budget, that corporation tax will be increasing, and that's going up from 19% to 25% by 2023. Capital gains tax is the uncertainty. It's a politically difficult subject because if the rates are too high, it can be seen to discourage investment. What do we know is happening at the minute with capital gains tax? Well, it's currently being reviewed by the Office of Tax Simplification. And there was a lot of speculation earlier this year that the rates were going to raise, which is why, as Steve said, we saw the increase in deals up to March. But those changes didn't come through then. The whole tax is being reviewed. So where we are is, it is likely that capital gains tax will go up in the future, but you have a window of opportunity. There's nothing going to happen immediately. So what do we say about tax? We always say you either plan for what is known or you get yourself into a position with tax in the future where you can take advantage of certain reliefs that mean that you don't need to be too worried about the scheme and the changes around you. So looking at those in a bit more detail, moving on to my next slide. So I have split this down into two forms of common forms that we see for capital investment in a company. We have what I'm calling the direct investment, which is via a subscription for shares, where the investors come directly in. And we have what I'm calling here an indirect investment, where a holding company is formed and the original shareholders and the investors both hold their investment through a holding company. Next slide, please. So I'm going to look at direct investment first and some of the key tax issues here. Well, the point to make with a direct investment is that there is no actual disposal for the original shareholders. The investors are coming in and subscribing for new shares in the original company, thus they dilute the original shareholders. Therefore, the tax issues to the original shareholders are minimal. What we're looking at here is what's the tax position for the investors. And as a subscription for new shares, which could be directly in the company or via a venture capital trust, the individual may qualify for some tax reliefs under the recognised venture capital schemes. I'm sure you've probably heard of them. We've got the Enterprise Investment Scheme, EIS. We've got Seed EIS, which is Seed Enterprise Investment Scheme, SEIS. We've got Social Investment Tax Relief. And the venture capital schemes provide a number of tax reliefs which make the investment much more attractive to the investor and therefore potentially easier for the company seeking investment to obtain. Next slide, please. However, not all of the investments qualify for these venture capital scheme reliefs. There are absolutely stringent conditions that have to be met by the company and the use of the funds, conditions to be met by the investor, and conditions to be met for the share issue. Fortunately, a company can apply to HMRC for an advance assurance that it and the proposed share issue qualify for the relief. You can't get an advance assurance for a specific investor, but it does mean that as the company seeking investment, you can advise your potential investors that you yourself, what you're doing and what in your company does qualify for the reliefs. The qualifying conditions must be met at the time of the investment, and something that is often overlooked is that they have to continue to be met for the following 3 years if the investor is to keep the tax relief that they've achieved through their investment. If not, if the conditions are not met, then the relief is withdrawn. The one thing that I have to say about EIS, SEIS and these types of reliefs, and just to repeat, is that the conditions are stringent, and there may be two ways of achieving the same investment. You get to the same end point, but you take 2 different routes. One route will qualify for the EIS relief, the other route won't. So the advice is seek advice early, make sure you've got plenty of time to get your advance assurance, and make sure you've got plenty of time for planning. One thing I've just popped on the slide there is not to forget investors relief. This has been around for maybe about 4 years, and like EIS, you have to hold your shares for 3 years to qualify for this relief. So we're only just starting to see people claim this relief, but it's for individuals where perhaps the company itself didn't qualify for EIS. It wasn't doing a qualifying trading activity. An example might be property investment, something like that. But investors relief may still apply in those circumstances, and the benefit of investors relief is it's a 10% capital gains tax rate when their investment is ultimately sold. Next slide, please. I don't propose to go through these in full detail, but this is just to highlight to you the kind of tax reliefs that come when you make an investment under a venture capital scheme. You have income tax relief, so the individual gets tax relief on the investment that they make. If the individual has previously had a capital gain, has sold another asset and has a gain, you can reinvest into the qualifying investment, and you can either defer that gain, or with the case of SEIS, 50% of the gain is exempt. Ultimately, on the eventual sale of the investment, if everything's gone well and you're going to sell at a capital gain, the gain is exempt from capital gains tax. And if the investment didn't go as well as planned, so that you've got a loss, you can offset that loss against other income. So you can see that the range of tax reliefs that are available through these schemes is extremely wide and generous, and that's why the rules are so stringent. Next slide, please. So moving on to look at an indirect investment. This is where the investor takes their stake via a new holding company. You can see on the left there, we've got the investors who form the holding company. We've got the original shareholders with their company A. The two come together by the original shareholders selling company A to the holding company, and both the investors and the original shareholders have a stake in the holding company. In this case, the shareholders, the original shareholders, are making a sale for which they're going to receive different forms of consideration. It might be cash, it might be shares, it might be loan notes, it might be deferred consideration. But the original shareholders do make a gain, a disposal in this circumstance. Moving on to the next slide, please. So an indirect investment, as well as securing investment and expertise for the company, an indirect investment is also can be an opportunity, as Mike said, for the original shareholders to release some value or de-risk themselves. As a disposal of shares, the tax treatment will affect the return that the original shareholders receive. So the key questions for those individuals who are de-risking is, how is the consideration taxed? Am I going to be within the capital gains rules, or could I be taxed as a distribution? Distribution is effectively taxed as a dividend, where the tax rates are much higher than capital gains rates are currently. Distribution rates can go up to 38.1%. And the other question is, when is the consideration taxed? If I've taken shares or loan notes or deferred consideration, when will I be taxed on that? The tax treatment for any particular transaction depends on the facts of that case. It's unique in each circumstance because each deal is unique. And it also depends on whether or not HMRC would invoke anti-avoidance legislation. Anti-avoidance legislation is around the timing of the gain and also whether or not a disposal will be treated as a distribution. Fortunately, you can seek clearance in advance from HMRC as to whether they would be looking to invoke the anti-avoidance legislation. So you can get assurance on what you're doing in advance of the transaction. The key message I would give you here is that HMRC in the last year to 18 months has become much more stringent in the approach it's taken for these clearances, particularly the clearance regarding whether or not a transaction is in capital gains tax or a distribution. And so what you need to do is seek advice early so you can factor in to the process the time it might take to get that clearance, so you know the certainty that you have in terms of your investment. And with that, I'm going to hand back to Steve.
That's great. Thank you, Adrienne, and thank you, Jeremy and Mike also. You know, it was great to hear your personal story, Jeremy, and it was great to know that you can continue to make losses in businesses and continue to see them grow at the same time as well. And what I particularly took from that was in terms of the idea of de-risking shareholders, and they're a lot more freer once their fear of losing something has probably gone away, and once they've just de-risked a little bit as well. And it's good to see that you're long-term investors as well. So 15-year investment in D-Line already is fantastic, and I think it's quite different to how many other venture capitalists and private equity backers think. So I think what I'll do next, I'll keep an eye on the conversation. If you do have a question, please put something into the little bubble and icon which is on the top of your bar for Teams. We've had a couple of questions beforehand, and I'll ask the first one of you, Jeremy. And the question is which type of skill and experience do you think is most relevant for a private investor or for venture capital to bring to an early stage business? Is it specific sector experience and connections, or is it generic business growth experience?
Well, I think they're both bonuses, but I don't necessarily know that they're the most important thing. It's interesting, if you do a survey of venture capitalists and ask them what do you think is the most important thing, they'll all tell you it's about the added value and the skill that they bring, connections and all of that. And if you do the same survey amongst entrepreneurs who receive the money, they'll say it's the money. and what I would say is the most important thing is you want a financier who has aligned objectives with you, i.e. somebody who believes in your business, who's prepared to follow you if you want to follow, who will exit when you want to exit, and who you'll enjoy working with. Because although the other things are important, you can hire them, or you can find non-exec support. So that's how I thought I'd answer.
No, that's great, thank you. And do you find that with businesses, how often would you or Mike spend time with those businesses to once you're on board with them?
I think it depends what stage you're at. Like most investors, we get most enthusiastic when we first start, so you have to understand the business. We're always represented. We might not be a director, but if not, we like to be an observer on the board, and so we play a full role in that. And then whatever the right, so yeah, there'll be the board meetings, but then it's whenever there's an opportunity, wherever we think we can add some value. It'll be Mike or I or another member of the team, and quite often it's not officially at board meetings. It's you talk to the chairman, what are we going to do, or you talk to the entrepreneur, and it might be about a senior person. Are they the right person? It might be, do we do this new product? It might be, is there a new partner we should try and form a deal with? Are there introductions you could do? It could be any number of things like that. So the trite answer is it's whatever makes most sense, because we're both entirely aligned on wanting the business to achieve its full potential.
Okay, and one further question I would ask. Obviously, you mentioned with D-Line there was growth in USA, and the appointment of a chairman seemed to be critical for that. How do you go about finding that chairman with the company owner?
Well, it helps if you work with them, which can be the case. I think appointing somebody very senior or a chairman is extremely difficult, and I think the first thing is to make sure you've got the spec right. What are you trying to achieve? So in the instance we talked about, D-Line, Nick had blue chip experience of running businesses in the same sector. So he happened to come, and there's a high level of trust because I had known him for a long time. And so I think it's a sort of thing where you work your networks, you take references, you get to know people, and sometimes test first. So maybe somebody joins the board before you make a chairman appointment. I'm not suggesting it's easy.
Okay, thank you. I've got another question from the audience as well, and this is probably quite a direct question, so I'll pass this one to you, Mike. But would Middleton Enterprises wish to engage with an established price and product comparison and booking.com platform, or in the tire market or in the tire aftermarket? So it's quite a generic, it's quite a specific question, but you can answer it generically if you want to.
The honest answer is as ever, it depends. Would we wish to engage? Yeah, really happy to have an open conversation. Obviously, our details are on the slides. I think they're getting shared, so we'd be more than happy for someone to reach out and we'll have a chat. The reality is that our level of interest would depend entirely on the stage of the business and the quality of what it's doing. But the whole point is, we want to hear from people who think they've got exciting, great ideas, and so we'd love to have a conversation.
No, that's great. Thank you, Mike. And I'm just looking at the moment. There isn't any other questions lined up at the moment. So what I'll do is I'll just see if anyone wants to raise their hand or press the raise hand button on this on Teams at the moment to ask a direct question. But if there isn't any other direct questions at the moment, then what I would say would be given that it's almost 11:45 now, I can see that Gavin Marshall, you've raised your hands. Do you want to ask a question?
Yeah, just to get some advice. I asked the direct question earlier on there, just so we will reach out to you, Mike. You sound like you're looking for more established businesses than where our business is at the moment. And we do need funding, and we're out there looking for funding as we speak. And we're in the middle of that process. What would your advice be, given that you are looking for businesses that are perhaps maybe further down the line in terms of making profit? If you're not there, where do you go and how do you go about it?
Well, I think that part of the fundraising game, certainly in my experience of being on the other side of it, as well as the investment side of it, is all about finding the right match. So there are definitely people out there. So it sounds like you're more of in a cash burn, early stage venture capital type operation, and there are lots of people around who are funding those sorts of deals. Jeremy alluded to our conviction network, which is doing sort of software as a service things, and they're super focused on those. But then finding people who are interested in the right stage of business that you're at. And certainly in the Northeast, there are all sorts of different funds that are doing that level of investment. So maybe you're not quite a match for us, but there are definitely people to go to. And so someone like a North Star would jump to mind immediately, but they're by no means the only one. So again, if we have a conversation, then I'll also, if I understand your business a bit further, I'll see if I can try and point you in the right direction.
We'll reach out to you. Thank you very much.
Can I just comment that I think the best investments often come when you've known each other a long time. So we do quite a bit of talking to earlier stage businesses because we like to see whether you're able to do what you say, and you might get used to us as well. So whether we provide, it's in our interest that you get funded if we think it's a great idea, even if it's not us. And that might, if we have the connection, when it is a big sexy business and everybody's fighting to get into you, which I'm sure is only a matter of time, then we'll be in there, elbowing them out the way.
Okay, thank you. Thanks, Jeremy. Yeah, we'll reach out, Mike, if that's okay. Thank you very much.
Excellent, thanks.
Thanks, Gavin, and
Cheers,
thanks, Jeremy, and thanks, Mike. I'm looking at the screen at the moment to see if there's any other one else with a hands up. But if there is no one else at the moment, then what I would say would be obviously to thank Mike and Jeremy and Adrienne for presenting today, but also to thank Caroline and Sam for organising things. We will be sending out the slides to those of you who have attended, and the video will go out somewhere on our YouTube channel or somewhere from the website. You'll be able to find it from MHA Tait Walker's website and also from Middleton Enterprises website. So the final thing is to thank you all for your patience, for your interest, and for attending the webinar. And have a great day. If you've got any further questions, then feel free to contact either Mike or myself or Adrienne. So thank you very much.